You've checked your credit score, it says 720, maybe 740. You've been paying your bills on time, no late payments, no collections, nothing crazy on your report. So you walk into the bank or you apply online confidently and they deny you. Or worse, they approve you for only $500. And you're sitting there thinking, what is going on? Your score is fine, your history is clean, but the bank is treating you like you just walked out of a bankruptcy. And here's what nobody is telling you. Your credit score is not your credit profile, and the banks don't fund scores, they fund profiles. That's the one distinction. Right there is the reason why most people stay stuck. And today, I'm going to break down exactly what the banks are looking for when they pull your file. Because once you understand this, everything changes. If you clicked on this video, you already know something is off. You've done what everybody else has told you to do. You've paid your bills. You've kept your utilization low. Maybe you even tried disputing a few things on your report, and you still can't get the limits or the approvals that you know you deserve. Most people think the credit game is about the number. Get to a 700, get to a 750, and the money flows. And that's the common belief, but it's costing people thousands. Here's what's actually working. Banks are not looking at your score in isolation. They're actually running your entire profile through an underwriting lens. They want to see what kind of borrower you are, not just whether you pay your bills. I learned this the hard way. Before I built Opulent Consulting Group, I was helping a close friend fix his credit. His score wasn't decent. No car loan, no credit cards with real limits, nothing. And when I dug into his profile, I understood exactly why. It wasn't his score, it was everything around it. So in this video, I'm going to show you 3 things. 1, what comparable credit actually is and why it matters more than your score. 2, the silent profile killers that are tanking your profiles right now. And 3, the exact moves to fix it so banks start saying yes. Let's get straight into it. Before I get into the framework, I want to plant something in your mind. What I found out after working with hundreds of entrepreneurs and business owners is that the reason most people are getting denied, even with a good credit score, isn't because of what's on their report, it's actually because of what's missing. There's a specific thing that elite borrowers have on their profile that signals to lenders that this person can actually handle real money. And I'm going to show you exactly what that is at the 3-minute mark. But first, you need to understand why the score alone is a trap. Think about it like this. Your score is the bouncer at the door. It gets you in the building, but once you're inside, the banks are looking at everything else. And here's what they're actually evaluating. Number 1, the quality of your accounts. Not just that you have accounts, but who actually issued them. There's a massive difference between a Chase Sapphire Reserve card and a Victoria's Secret store card. Both show up on your credit report. Both might have perfect payment history, but one tells the banks that, this person operates at a high level, and the other tells the banks that, this person just stops at the mall. Banks, specifically tier 1 banks like Chase, Bank of America, Citibank, Wells Fargo, they want to see that you've already been trusted by institutions like them. It's a reference letter. If your references are all from prestigious firms, you'll get the job. If your references are from random places nobody's have ever heard of, they'll actually hesitate. And that's comparable credit. Number 2, your credit limits. This one is huge and almost nobody talks about it. If the highest limit you've ever had is $1,500, a bank is not going to hand you $50,000. Why would they? You never demonstrate that you can actually manage that level of responsibility. Think about it from the bank's perspective. They're not being mean, they're just being logical. They're asking, has anyone else trusted this person with significant money? And if the answer is no, they're not going to be the first one to take that risk. And this is why I tell every single client, stop chasing low limit cards. A full wallet of $500 and a $1,000 limit cards is not a credit profile. It's what I call a liability. Now, that's the quality side of the equation. But even if you have the right accounts, there are silent killers on your profile that are quietly destroying your approvals. And this is where most people are bleeding without even knowing it. Let's talk about what actually is tanking your approvals. Because your score can be 730 and these things will still get you denied. Killer number 1, high utilization. I don't care what your score says. If a lender pulls your report and sees that your cards are sitting at a 60, 70, 80% utilization, they see someone who is stretched thin. They see financial stress. Even if you're paying the minimum every month, the sweet spot is between 1 and 4%, not 30, not 10, 1 and 4. That's what signals to a lender this person actually has access to money and doesn't need it. And here's the thing most people miss. It's not about what your utilization is on your statement date. It's about what gets reported to the bureaus. If your statement closes with a high balance, that's what the banks see. And this is why off-cycle reporting exists. Banks like Chase, Amex, Bank of America, Capital One, They all have ways to request early reporting. Use them. Killer number 2, too many inquiries. Every time you apply for credit, it leaves a mark, and lenders see that. If you've had 6, 7, 8 inquiries in the last 6 months, you look desperate. You look like someone who is hunting for money because they need it. And banks don't like to lend to people who look like they need it. They lend to people who look like they don't. Keep your inquiries under 3 in any 6-month window. And never, I mean never, remove an inquiry that's actually tied to an open personal card. It could trigger a risk to shut that card down. Killer number 3, consumer credit products. This is the one that surprises people the most. Store cards, buy now, pay later accounts, Affirm, Afterpay. These things are on your report and they're telling a story. The story they're telling is, this person makes impulsive purchases and finances small things, which means that you most likely don't have money. That is not the story you want to tell to a bank when you're asking for $100,000. Now, I'm not saying these things will destroy your score. I'm saying they're quietly communicating to underwriters that you're not operating on a high financial level. And in the credit game, perception is everything. So now you know what's hurting you. Let me show you what actually fixes it. This is where it gets practical. Step 1, prioritize bank issued accounts. Your goal is to have primary accounts from tier 1 institutions: Chase, Bank of America, Citibank, Wells Fargo, American Express. These are the names that carry weight in an underwriter's eyes. And if you don't have them yet, that's where you start. Not with a store card, not with a credit builder app, with a real bank that has real pull in the lending world. Step 2, request credit limit increases every 91 days. Banks operate on 90-day cycles. Every 91 days, if your bank allows a soft pull increase, request it. This does 2 things. It raises your available credit, which lowers your utilization automatically, and it builds a track record of high limit management. The goal is to have accounts that show limits of $10,000, $20,000, $30,000 or more, because when a lender sees that, they see someone who has already been trusted with a significant amount of credit, and they're far more likely to extend more. Step 3, use the all but one method. Instead of carrying small balances across 5 or 6 cards, pay everything off. Leave one card with a balance between 1 and 4%, just one. This consistently produces scores higher than just spreading small balances across multiple accounts. And more importantly, it shows lenders a clean and controlled profile. Step 4, keep your accounts active. Do not, I repeat, do not close cards that you are not using. That kills your credit age and your available credit at the same time. Instead, nest them. Put a small reoccurring subscription on each card like Netflix, Spotify, iCloud storage. Set it up to autopay, and the card stays active. The issuer doesn't close it for any inactivity, and your profile stays healthy. Let me bring this all together. Your credit score is not the problem. Your credit profile is either working for you or against you. And the difference between someone who gets approved for $5,000 and someone who gets approved for $150,000 is not luck. It's the quality of accounts on their profile. It's the limits they've demonstrated that they can manage. It's the story their profile tells when a bank pulls it up. I watched my friend go from being denied for a basic car loan, spending thousands on Uber every month, to having access to real credit, real funding, real leverage. Not because his score jumped 200 points overnight, but because we rebuilt his profile the right way. That's the work we do inside of CEO Launch. We don't just clean up your report, we position you. We build the kind of profile that makes banks compete for your business and not the other way around. If you're sitting on a decent score and still getting denied, your profile needs work. The longer you wait, the longer you're leaving money on the table. Join our CEO Launch School community in the description. Come in, let's take a look at your profile together, and let's build something that actually opens doors. Now that you understand why your score isn't the whole story, the next thing you need to know is how to actually use that profile to get funded. Because fixing credit is just step 1. Knowing how to stack funding sequences across the right banks in the right order, that's where the real leverage is. I made a video breaking down the exact funding sequence I run for clients to get to 100K to 250K. Watch that next, because your credit profile and your funding strategy have to work together. One without the other leaves money on the table. I'll see you there.